Debt is the root of all evil. It's a saying you may have heard before. Don't get into debt because that's slavery. That's kind of true, because when you have too much debt, your life is over. You don't have to wait for your debts while you try to pay them. Since no one lends money for free, they are getting bigger every day. There is always an interest despite of all of this. The United States has accepted that the total amount of consumer debt in the country is close to $15 trillion, which means that the average debt for a family is now over $5,300. The US gross domestic product is just over $21 trillion, which means that debt makes up the whole economy. But there is some good news. Debt isn't always bad. You undoubtedly owe money on your credit cards, car loan, and/or student loans, and you're under the impression that it will take decades to pay it off. How in the world could that be a good thing? Let's take a look at how people who have a lot of money are still able to use that to make even more money. It may sound a little complicated, because after all, why would anyone with a large sum of money resort to taking on debt? People without money are supposed to use this. But that's not how capitalism works. Debt is a powerful tool if you know how to use it. Welcome to the Investing Wise Academy, a channel where aspiring millionaires and billionaires can learn how to invest wisely. In this video, you will find out how rich people use that to make even more money. If you're new to our channel, please subscribe to see more videos like this. Let's get started. Number 1. Trade is largely financed by borrowed money. Starting a firm using borrowed funds may sound contentious, but that's because it's a bad idea. However, debt is the greatest option for some organizations, particularly traditional ones. Suppose you're in the business of selling pens. A lot of people use it and there's always a need for it. Ideally, you'd fly to China and locate a factory that makes this type of pen at an affordable price point while maintaining high quality. In this case, you'd buy an entire container of pens, send them to the United States, and distribute them to your customers. Today, however, most of this is done online via websites such as Alibaba. The only exception to this rule is if the product is so intricate that it necessitates a trip to the manufacturing facility. But there's a catch. You don't have to pay for the things in order to get them first. Let me explain how, in the last 50 years, China has transformed into the world's factory, creating almost everything. Thousands of factories operate around the clock to manufacture everything the world requires. Most of these factories would gladly lend you their products to make it easier to sell. In exchange, you would pay them at a later date. They would not lend to strangers, of course. You'll need to establish some level of trust with them first. But that has been the way business has operated for the past 50 years. The client would pay the factory and borrow more products after the product was sold in the United States or anywhere else in the world. What makes this strategy great is that you're not tying up your own money in this transaction. That's why selling is one of the most important skills you can learn. Number 2. Refinancing. If you want the best type of debt, you should get into real estate. You're overpaying taxes if you don't have a mortgage. In order to maximize deductions, the rich always have many mortgages. Whenever you save money on taxes, you're actually earning money. This is just another method by which the wealthy might amass even more wealth. We can, however, provide you a more realistic solution. This is essentially how wealthy individuals become wealthy in real estate. Take a conservative estimate of $200,000 as an example. That's a lot of cash. However, if we're being honest, that's a drop in the bucket. Even buying a house is out of the question. You can't acquire an $800,000 mortgage since you'll need a 20% down payment. However, there is a secret to it. Let's imagine you come across a home for $500,000 and decide to make an offer. A lot of work is needed to bring it back to its former glory. To obtain a mortgage, you must deposit a minimum of 20% of the purchase price. When it comes to remodeling a property, you need to invest between $10,000 and $50,000. You go back to your bank to refinance your mortgage, this time at a lower interest rate. It was only worth $500,000 when you obtained your first mortgage, since it was in such horrible shape that no one wanted to live there. However, now that you've renovated it, tenants are lining up to rent it. As a result, the property now has a market value of $700,000. Let's say you're going to acquire an 80% mortgage, but out of $700,000, you only get $560,000. Your first bank, which loaned you the original mortgage, will get $400,000 of that money back. In order to get an extra $110,000, you need to subtract the $50,000 you spent on refurbishment. Now, you just made $110,000 and you're left with a property that you can rent out to build equity and generate passive income. On top of that, you are going to avoid paying taxes because you have a mortgage. Real estate investors frequently employ this strategy. Can you now see that this idea is not that horrible? Let me know in the comments if you have an opinion on that. Number 3. Hedge funds. Hedge funds are created by the wealthy for the wealthy in order to increase the wealth of the wealthy. They usually use unpopular strategies. Normal people like us, we put out our best efforts to anticipate which firms will expand and increase in value, and we invest the money we have worked so hard to earn in the hopes that these companies will thrive. But hedge funds often use a completely opposite strategy. When a company goes bankrupt, they try to profit from it. As was the case with GameStop, internet-based hedge firms lost nearly $13 billion as a result of that incident. But how do hedge funds make money with debt? Suppose that you have anticipated a fall in Facebook stock. Because you're aware that Apple, the manufacturer of the most popular smartphone, will declare next week that they will no longer allow apps like Facebook and Instagram to track your online activities and will instead prioritize your privacy. This will cause significant harm to Facebook's business model. Then, you pick up the phone and call your broker to borrow a single $100 Facebook stock, which you immediately sell for $100 on the open market. Congrats! $100 are now in your possession. However, you owe your broker one Facebook share. Suppose you are correct, and next week the price of Facebook shares falls to $70. You spend the $100 to purchase one Facebook shares at its current price of $70. Then return it to your broker and pocket the difference. Congrats! You have produced $30 out of a full stock. In theory, it appears simple, but in practice, it is exceedingly tough and risky. What happens if you're incorrect? What if the price doubles in an instant? You must still return that single Facebook stock to your broker and pay interest on the loan. You must now purchase that stock for $200 in order to return it to your broker. When you buy a stock and try to sell it when it increases, the most you can lose is the amount you spent. But this is not the case of shorting. If the price continues to rise, so will your losses. In theory, you can incur endless losses because the stock price can climb indefinitely. However, if you have 100 analysts working for you, this method can make you a fortune. Number 4. Forex. Forex is a market for trading currencies. It enables international trade. For example, in China, you can use the US dollar. To pay your staff in China, for example, you must purchase Chinese yen. There is a market where anyone or any corporation can buy foreign currencies. These currencies change due to a variety of circumstances. For example, if the Fed raises interest rates, the supply of dollars in the market will be limited. making the US dollar stronger against foreign currencies, or vice versa. You may make a lot of money in this market if you can anticipate which currencies will climb or decrease. What sets the forex markets apart from the rest is the ability to borrow up to 100 times the amount of money you spend to trade. That means that if you trade with $1,000, you can have a stake of $100,000. Even if you only make a 1% profit, that's a lot of money. Number 5. Credit score. Clearly, debt is an effective instrument. Each successful firm and entrepreneur utilizes debt in a variety of ways, particularly if you have a successful business model. Almost all businesses borrow money to finance purchasing orders, so stop thinking that all debt is bad. Obviously, debts with high interest rates, such as credit card debts, are terrible. But to obtain a lower interest rate, you must decrease the risks associated with lending you money. How do you accomplish this? You develop a reputation as a dependable borrower. There are billions, if not trillions of dollars waiting to be borrowed from banks, and even if there is no money, banks can manufacture it out of thin air. That's all for today. What are your thoughts about debt? Join the conversation in the comments section below. Please click the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.